Testing, testing. Oh, those levels look just fine. Hello, hi. Welcome to 51% Attack. Live show? Not really live show. I'm sure more people will watch this after. Sorry if there's... I have NVIDIA RTX voice. I don't know if it's going to block out the construction in the background. I have the windows open. Um, yeah. So, I'm just going to kind of wing it. Yeah, live close. I know, right? Special. You'll see all my wacky anxiety inducing, like, oh, is it gonna go up, is it gonna go down, with the final like 5-minute candles. But yeah, we'll just we'll switch back over to that kind of thing when we get closer to close. Yeah, we got 20 minutes or so. Otherwise, let's just wing it, go down the list. I missed my weekend update because life gets in the way. What did I start on? Oh, the Nasdaq. Oh, we'll talk about that. Look at Mr. Nasdaq. Or is it female? Actually, I don't really know. Nasdaq's probably non-binary. Ooh, just fighting there at the end for a new yearly low close. What is it? 971 and yikes. Yeah, 971 is the 10,971 is the number. So we'll come back to that. Nasdaq had a that's actually not, I mean, it's not a demonstrably worse day than the others. I haven't really looked at this, so this is all kind of fresh to my eyes, so I'm kind of just going off what I see. Um, Surprising that it has not gone near this gap yet. Anyway, we'll get that out of the way once the things start to close. Going back up to the top of my little list of things I like to talk about. Here we go. So we got the dollar DXY looking not terribly strong, but definitely stronger, than it was last week. Going into last week, we're on the daily here, so currently there's still plenty of potential for either a lower high. As you can see, it was up above 114 a couple weeks ago. So if it doesn't even reach 114, you've just got a straight up lower high, which is great, bullish for equities and crypto and all that kind of stuff. And then if it does breach this 114, looks like 114.19 or so, if it gets above that on this latest stretch, because it is technically flipping bullish momentum, although it's doing it on a very, very narrow slope. I wonder if I have does this work? Ugh, that looks terrible. I'll just describe it to you. You can listen to my voice. You can see the slope here and momentum. It's coming up towards the bullish side, but it's pretty flat and pathetic. So this could definitely be a lower high, or even if it does breach 114.20, a divergence on the RSI is really shaping up. Last time we checked on this, let me get rid of this ugly line from some older stream. Last time I did a stream, we talked about how the daily bearish divergence on the dollar had been invalidated. So we were expecting, renewed strength on the dollar, because here you can see we got a higher high peak on RSI with the price pump. So that got rid of any kind of daily hopium. But it's forming again. Now we've got this really 78.5 down here on the RSI. The potential for the price to, set a higher high above 114.20, but put in a bearish divergence on the RSI, that would give us a decent amount of good feelings going into the, middle or back half of October, which is where I'll stick to it until it doesn't happen. I do think that is going to be a pivotal point. I do think the market is it's going to decide. I am betting on it going up then. If it just gets trounced and heads down, it will do so also with force. And regardless, I do think that, mid-October, back half of October will be a decision, up or down. I can't say yet. I'm betting on up based on history. But anyway, so the dollar is, potentially, lower high or bear divergence on the daily. And if you go out to the weekly, we do see that there's just a monster bearish divergence still playing out, just barely, but it's a double divergence. Yeah, look at that. Higher peak, lower peak, just barely by a few percentage points. So this just speaks to the theory that I like to say it's a rubber band. The rubber band of bearishness is being pulled back. Bearishness on the dollar meaning hopefully bullishness on the markets. The bearishness rubber band is just being pulled back, back and back and back and back. It's been getting pulled back since May, and it will snap. It always does. We don't know when. Nobody can say exactly when, but in terms of managing your risk and planning for trades and managing your portfolio and what you're doing in the year ahead, again, rubber band is being pulled back. It will snap. It always does. We just can't know when. So yeah, pretty decent double, possibly triple bearish divergence on the dollar weekly. So that's good. I promised not to talk about the Japanese yen anymore because it's just doing a thing, so we'll skip that. I'm also checking on the time, so we got 15 minutes left. I'll let me get through these yields, and then we'll go watch the charts live. So yeah, the U.S. 10-year. I guess we'll just stay on the weekly for now. Same deal. You've got this rubber band being pulled back. You've got this higher high price, obviously, and just lower highs on the RSI. Back in May we were at 81.5, 81.6, and now we're still, it's just at 76.4. So once again, we do want yields to go down because it will remove pressure from especially risk on assets. And so we're rooting against yields, generally speaking. And same as with the dollar, there is a bearish divergence forming here. Rubber band is being pulled back, and that's on the weekly. So if we go to the daily, let's just see what the near term looks like. Looks like this is interesting. Okay, so this opened at 3.945, and we are above that at 3.961. So officially on the daily 10-year yield, we've got the bearish divergence currently printing. If it ends the day here, that is a bearish divergence, and you can start to incorporate that into, again, how you manage your risk and manage your trades. That's nice. That's nice to see. It does, suggest that there could be some relief coming to risk on assets. Whether it will be a large amount of relief or just near term, don't know yet. But in terms of the rubber band theory, the rubber band is firmly pulled back. Like this is and on the daily. That's nice to see. Again, that is if we close the day here on the 10-year yield, that is a higher high price. Not demonstrably so. It's not above the Stings high. It's not above the the highs for the day, the intraday highs, which is where you really start to say like, okay, this is a printed divergence. But we go close to close, wick to wick, and so the close will be above the close if it stays here, and that will be a bearish divergence as well on the daily 10-year yield, which is nice. Continuing on, let's do the 2-year yield, which is a bit more of an immediate and reactionary way to look at the markets. Tends to just move a little bit faster because by the nature of its contracts, being only 2 years. So let's take a quick look at this. We're on the daily 2-year yield, and it looks like it's still just below those end of September prices. So there's no divergence yet printed. Could still be a lower high, could be a bear div later on. Not much to say there on the daily. We're just watching. Pull back out to the weekly. And I mean, it's just been diverging for basically the entire calendar year. Not so easy to do it with like drawing peak to peak because of how rounded it is, but very clearly you can see that strain, that pullback of the rubber band, as I like to say, because it's just, I mean, this thing's been overbought, if you can say that about yields. It's been overbought for basically a year at this point, and just going up and up and up. That doesn't mean you necessarily bet against it in any sort of near term, but that strain, that tension, the rubber band is being pulled back. It will snap, and as soon as you see the momentum start to fall, is when you get a shot at that. So you can see, back here in February, there was a chance for it to continue. February into March, there's a chance for the yield to continue going down. Obviously, we got the Fed and bad news and wars and all that stepping in. They were able to just keep pushing it higher, and the momentum never really, as it turned over here in May, it never got low enough to, continue further down. It never set any kind of lower low, and so we're back up at highs. But being at highs means there is, again, that tension to pull it back down. And, it's firing at, momentum's at a full 100. It's fully overbought at 82 on the regular RSI. it's certainly a point where it can roll over, but we do have to pay attention to these moving averages. You can see the looks like the 100 week is about to um, cross above the 200 week, and if we look back at the last time that happened in 2014, it did show some persistence in the 2-year going up. Now, who knows if that'll play out or not? Something to keep an eye on. And what else? We've got the yield curves. The 10/2. There's no new news here. Just to say, firmly inverted. It's still remaining inverted. Been inverted for all summer. Started in the spring and then continued all summer. So yield curve is firmly inverted. And just a reminder that generally speaking, the recession, the big plunge, the big dip doesn't happen while you're inverted. It's when these shoot back up. So when you start to see, boom, this thing, well, it'll be green. When you start to see that shoot back up is when the trigger gets pulled. You can see 2019 into 2020 was a little bit off, but as I've said before, COVID is a weird beast. But you can see this more adequately back during the housing crisis. Firmly inverted here all throughout 2005 to 2007, a couple of spikes up. But here, when it spiked back up, middle of 2007 and then stabilized over the weeks, probably right around here is where you start to see the market teeter. And of course, by September, when it failed to break below any kind of moving average, September 2008 is when it collapsed. So you're looking for this up, this ramp up, and that's when it's time to typically to buckle down if we're talking about history and statistics. So yeah, that's what we're looking for there. And lastly, before we go watch the market close, here's the 10-year over 3 month, which supposedly from all my reading and research is what is actually the Fed's preferred yield curve to watch in terms of fear and policy, and how they make their decisions. The 10 over 3 month never fully inverted. It got very close. By close I mean like the momentum clearly went down. Starting in this summer, but it never crossed below. It never went negative. What is unusual, and I've mentioned this before, and I don't really have a take on it, just to say it's unusual, are these repeated stings down, constant testing of what looks like the 0.125% range, just sting. And we've looked at this before. This is a full inversion back before COVID, but the stings down, like repeated stings down, aren't something that it didn't happen before the housing crisis, at least not that I can see. There weren't like repeated tests of that kind of arbitrary zone. I guess there's this sort of tweezer in February of 2006, but that I don't think 1 month makes for a pattern. So I don't really have anything to say about that. I just wanted to call attention to it because it's just very odd. And if anything unusual happens with this upcoming recession, this could be a sign of that. I don't know. I'm putting it out there. I'm putting it on the board. It's just weird. All right, so let's go take a look at SPY. See how we're doing. Whoa, my SPY chart is very busy. I'm sorry. I'm gonna turn off the moving averages because I don't think that's gonna matter for the close today. Trying to clean this up. So what are we looking at here on the SPY? We had a 3-day gap down gap up failure. It's been a really hectic week. I think I described it in a post on Reddit. This is the last gap up that we had the prior week, and so we, as I like to say, start the count. You have 3 days to solidify that gap, to hold it as support, and then to bounce up. And so gap up into Tuesday. Wednesday was day 1, Thursday was day 2, and then they failed day 3, plunging on Friday, and everybody was feeling pretty bad about that. So the 3-day gap theory still works. I'm going to remove this now because it's making my chart very busy, but I always want to keep up the last indication or marking that I had, so that for posterity, and so that people don't feel like I'm rewriting myself. This is the gap we had. So I'm going to get rid of that, and we're going to watch the new gap, which is formed out of it's been wild. We had this gap down into an island, then a gap up into an island, then a gap down, creating this island. It's wild, if you're watching the charts. So this is the current gap we're working with. We had a gap, of course, we had a gap down on Friday. So today is day one of trying to get back above 373 before that constitutes a failure, at least according to 3-day gap theory, and possibly setting up another leg down. So this will be a long-term target for the rest of this week, is probably the 369 to 373 range. Diving into today, let's have some fun with the, should we do, well, we can look at 15-minute candles, and oh my goodness, it is flat. The market has not moved, just bouncing. We've got 5 minutes left. Let's do the 1 minute. Let's do the 1 minute. Let's just see what's going on. So this is, you're getting raw, uncut K-Brot right now, because I don't actually watch 1 minute candles, but it is interesting to see how, like, the things that we talk about in terms of oscillators and indicators, throughout the day on 4 hour and daily and of course weekly charts, they actually can play out in these extremely short-term intervals. It's just, don't bet the farm on it. So, like, you can kind of see how that candle ended. They intentionally closed it below this sting low of the prior candle. So they're going to try to bait out, as you can see they're doing now. They're either going to bait out or just plunge. Now, if they had kept this candle right around, like, the close here, or sorry, it's not the close, the open here of about 360.50, that would have given them a really good base, considering that, momentum is firmly negative. So, the bears are in control of the 1 minute chart. As ridiculous as that sounds, everybody keep in mind as we're looking at this is the 1 minute chart. This is purely for funsies. I talk about this in terms of, the oscillators and indicators that we use on much larger time frames. Here, we're just seeing how things sort of play out. So we're coming up towards the end of this candle, and it looks like it's not going to be any kind of fake out yet. They needed to kind of hold 360.50 to sort of bait that out. So we're looking at, again, momentum is firmly negative heading into the end of the day. Bears are in control of the near term, 1 minute chart. Let's see how this candle plays out. I thought maybe if it went green, they could have, it could go green and right back up to like this sort of halfway point on this candle. Sort of create a little miniature bear flag to get one final bait in on the end of the day, because it would have been, minute 58, minute 59, bear flag, and then just plunge it down, into the final close. Doesn't look like they're doing that. I don't think they're going to make it back up to, was it 360.45, something like that. I think doesn't look like bulls have the fight in them to do that. And so if they keep closing below these stings low, I think this is this is not the low of the day. I'm sorry. So the target, let's just put some targets up. So we've got, this is the close low of the day. Here's the sting low of the day. I'm just putting shit on charts. We're just going to see what plays out. So again, the first one was close low and the second one is sting low. We'll see if they target them or if they bounce away. Looks like they're bouncing away on this final candle. How far are they going to get? They're going to get stuck at, I guess I'll put an upward targets too. That's only fair. 360.45 to create the sort of bear flag. Of course, we've got up here at it's going too fast. 360.65, and this is probably going to look at this gap zone, a gap on a 1 minute chart. That's unusual. This looks like a good place to end the day. 360, somewhere in this zone. I'm doing this fast, so pretend this is a zone. And oh no, they bounced way off that midpoint. So they went a little bit above the midpoint at 360.50, and where are they going to close it? Oh, and there's the candle. Okay. So I'll leave this up for a second because I'm curious to see if post-market they want to start testing this upper gap on the 1 minute. Again, when I say gap, like, this is not an important gap. This is like cocaine-fueled panda bear watching the 1 minute chart gap, like having fun with K-Brot. Because as I drink my Monster Energy drink to stay up through this. That's right, no apple juice today. So yeah. Really, the only target that played out, I guess this kind of bear flagging thing. I wonder if this corresponded to anything. What was this, 360.51? I'm always curious to show people like how I know, like, yes, TA is sorcery and bullshit and all that, but generally speaking, every number has a story. Like everything is something, and you can usually look back on a chart to find it. That's why I'm doing this. So this is a high of what 360.51. I'm wondering if that just corresponded with anything that I missed earlier, and it can help you sort of in the long run. It looks like, oh, was that corresponding to maybe these? Was there a lot of volume in that area? I wonder. Yeah, look at that. Okay. I think that's probably the culprit for that candle. There's a lot, yeah, there was a lot of end of day trading going on there. I'm gonna, I'm gonna call it that. Oh, yeah, look at that! Even if you go back, oh, yeah, all the way throughout the day. So I'm fully zoomed out on the minute chart, and look at these areas that it hits. It's really interesting, or maybe not that interesting. It's interesting to me, um, but yeah, you just see a lot of volume and pivoting around this number 360.50, and that's probably where that end of day battle came from. So the two things here, I'm gonna draw yet another line, and we're gonna make that line pink so that we can track it and you can kind of see what I'm talking about. So again, this sort of end of day bait candle, reversal candle. Look at just how many times they hit it today on volume. You can see like this area here, that's a pivot. Like as soon as it got up to it and broke it, boom, they tried to go up. They failed. But again, they kind of bounced around it on this candle here and then, had some action below it. And once again, came up to it and, bounced off it here. Here's resistance. Here it was kind of a pivot as they had to break through it in order to go higher. So it touched a lot of candles there. Here is kind of just looks like a breach of that candle, kind of sent them higher. And then into these two areas, just look at this pivot. It's just almost exactly halfway through these volume clusters, these trading clusters. So again, this is the line at 360.50, which was the final sort of rejection candle on the 1 minute, heading into end of day. And you can apply this again. I wouldn't recommend watching the 1 minute. That's insanity. But these kinds of patterns and these kinds of if you want to, if you want to be successful in managing your risk and this kind of stuff, and if you want to try to beat the robots, because this is all robots doing this, you need to kind of think like a robot. And if you just see how many volume clusters, how many areas this price touched, how many times they went through it, you can start to see why these patterns develop. And you apply it to much higher time frames that are actually useful and actionable. Again, do not trade the 1 minute, the 5 minute, unless you're a professional trader. Don't let me steer you away. But generally speaking, the 1 minute and 5 minute and all that, these aren't actionable, unless you're really on top of it. Yeah, just a little tiny end of day lesson to kind of see why did this number 360.51 show up, and you can see it throughout the day. Just volume cluster, pivot, volume cluster, pivot, volume cluster, pivot, volume cluster, pivot. And if we zoom out, I wonder, like, if we go out to just a more manageable, like 15-minute candle. Let me get rid of these bad guesses I had at targets for the end of the day, because everybody has them. Perfectly okay to have mistakes. It cuts almost a swath through exactly like the halfway point of the day. It's almost like that was the entire daily pivot. Was again this 360.50 line is kind of like some kind of determinant. You can see, just look at this, like in the late morning, as they just fought below it to get above it. It took a lot of bull energy just to like stay right near it, get above it, and then unfortunately they failed again, causing a midday plunge. I wasn't watching live, so this is all new to me. I'm actually looking at what the numbers were throughout the day. So forgive me if I'm kind of going off on tangents. But again, you can see just like how pivotal this end of day line was, and just defined by these candle closes on the 15-minute. You can just see it perfectly. So that's interesting. Pulling back out to the daily to actually do a little bit of cleanup. What did we hit? So here it is again. We've talked about it, 358. Now this one wasn't perfect. It looks like it went a tiny bit below to 357.67, but the sting low of the day, I mean, give me a break, guys. It was 30 cents off. 358. It's a hugely important number. Last week we saw it was they closed below it, which was, as I said, because I promised I would be fair, 358 was the number I was looking for to say, the market has broken. We now need to operate in a in a mindset of the market has broken, where it is in a state of brokenness, as I say, because it can be flipped around. We can be faked out. It can be ripped up. And look what they did. I mean, look what they did after they broke the market. Once they breached 358 over here 2 Fridays ago, or yeah, 2 Fridays ago, the market ripped up. They punished people who saw this as a breaking of the market and instantly just went short and started buying puts. They punished those people because they know this number was important. They know people were watching it, like me. But again, I didn't buy any puts off this. I'm not buying, I'm not shorting the very bottom. I want to see like how it reacts, how it bounces. Right now, they ripped back up, which could have proven like a fake out if they just kept going. Obviously the week didn't work out very well. It ended up in a giant gravestone shooting star. But if it had stayed up near the top, if it had closed above this gap, like 374, 375 for the week, that could have unbroken things. And that's why I like to say we're in a state of brokenness, because I don't want to break my promises. I know people were holding my feet to the fire like, hey, when are you going to stop bullshitting and coming up with lower and lower numbers? I said 358 was it, and I'm going to stick to that. 358 is the market breaking point. We are in a current state of brokenness. It can be undone, but in terms of managing risk and talking about like our expectations, we need to operate as though the market has broken. Now, as you can see, they retested 358 today and bounced fairly strongly off it. Like this, in terms of percentage, okay. I don't know about strongly, 0.6%, which is good for stocks. Not anything incredible, but we have to clock it. This is a bounce. Once again, if they rip this bad boy up and maybe close this gap, they've got 3 days to get back above 374. If they can do that on the SPY, 358 could have been it. And that's kind of what I've been saying in my post is I do think that, cannot call the bottom yet, but I think we're going to know. I think we're going to know very, very soon. And I think we're going to know it statistically and mathematically, not just from my gut feelings. Because we're in it. We're very close. We're at the end, This is Frodo saying to Sam, like, here we are at the end of all things. We're at the extreme, guys and girls. Like, we're going to know very soon. It's either gonna and if this continues to break, it can plunge. We've talked about some really devastating targets for the SPY. I've got them marked here, just in case. If this breaches with force, if 358 breaks again on volume, then yeah, look out below. I do think there's one last, like, if I were to fake people out, talking about one of these weekly rips, sort of wrecking bears again, the market will still be considered broken. I'm not changing that. But 342 roughly on the SPY, considering how it, forms a gap. This is the 2020 gap from basically where the bull run started. It's right around there, 342. You can see, we'll zoom in to when everything began in November 2020. So this is why I'm using that number, because the market loves symmetry. I'm sure you've heard that before, market symmetry. They love symmetrical markets. They love retesting, pivots and resistances and supports. And this is a major one that we've never revisited. There's a gap here on the weekly. I mean, gaps are magnetic on their own. A weekly gap has market makers, salivating. There are open orders here on a giant contract scale, on a weekly contract scale. This is an attractive point, and it's gonna be magnetic. And if we don't test it, this month in my hypothetical final dip down, if we don't test it now, it's extraordinarily likely that the recession plunge will go through 342 at some point. But that's where the number's coming from, is that 342. I had another, this would probably be an intraday number. I don't want to go too deep into these apocalyptic numbers. There's no point, but they're on the chart. They're there if you want to look at it. Everybody's been talking about SPY 320. Personally, I counted it. I did a little closer look. I think it's closer to 319, 318. But there's SPY 320 down there. They're on the chart. I don't want to talk about them anymore until we breach, because right now it's holding. Market is broken, but it has the potential to rip up. In terms of patterns, why can it do that? Well, last week ended up in a gravestone shooting star, which is bearish, it's a bearish candle. However, it stayed green, first of all. And two is that even the most bearish of patterns, like shooting stars and gravestones, they don't have as much power at the bottoms of downtrends. They're way, way more useful at the tops. Look at this gravestone at the top of an uptrend. That gravestone sent us plunging. This is something to watch for. And likewise, when you have a bullish candle like here, where you've got you got the hammer candle or the dragonfly, that is hugely important at the bottom. If we had a dragonfly here, I'd be almost all in. At least you'd have really good risk versus reward. But that's not what we have. Instead, we have a bearish candle, but at the bottom of a downtrend, which gives it less power. And if you're trading, and this is never, ever, ever financial advice, but if you're trading, you've got really, really good risk reward set up here. Again, can't emphasize enough, this is not trading advice or financial advice, but this is how you look at things. You know, if you wanted to go long here, either on a daily or a weekly scale, your risk reward is fantastic because look at this clearly defined stop. Really at 358, you know, depending on your risk tolerance and your appetite and how long you want to hold the trade, you know, 358 is a fantastic, hell, you could even set it, if you're nervous, you could even set it at the low of last week again, which was 359.21. That's if you're really, really conservative and nervous. Like this is where I would set, you know, if I were going long, I would just set a stop here. If I'm in a super conservative mode, set it at 350, 359, or give yourself some buffer room, you know, I don't know, 358, whatever your risk tolerance is. And as soon as that breaks, then yeah, you reevaluate, you know, you get stopped out and you live to fight another day. Because that's only a 0.25% loss, which in stock world is, or not in stock world, in trading world is nothing. That's a pleasantry as far as I'm concerned. If you only get stopped out 0.25%, that is a victory. It's kind of like a Vegas casino. You know, if you if you go into a casino and you end up making no money, but you've also lost no money, and you got all those comp drinks, well, that's a victory in my book. And that's kind of how I treat getting stopped out. So anyway, big risk reward here. You know, I keep saying the rubber band was getting pulled back, you know, with all the bearish divergences forming on the dollar and the yield. We'll take a look at VIX in a second. There's just, this is how I trade. This is how I look at numbers. This is where I would set, you know, this is where you could set your stop loss. It's a good setup. However, yep, if we break through 358 on volume, on force, we'll talk about lower targets. Right now, it's not doing it. It's bouncing. And I'm holding to my theory that, you know, mid-October, end of October, it's going to be a decision point. And I'm betting on up. I'm telling you that. I'm betting on up. And if I'm wrong, I'm wrong. You know, well, I've got stop losses. I've got targets below just in case. But I really do think that this week into next, got to be paying attention. So let's take a quick break from the chart. And actually, since I'm talking about the week ahead, let's talk about the calendar really fast, and then we'll get back into some of these things. I owe you guys a longer stream. So let's head over to the calendar. Let me make sure this is showing up on stream. It is. Okay. Oh, excuse me. I'm burping from this energy drink. Got to keep going. Okay. So yeah, today was just a couple of Fed speeches, you know, had people nervous, probably shook the markets a little bit. Tomorrow, a couple more Fed speeches. Could be volatility, could be no volatility. They're not JPOW, so that's all we have. Wednesday is when all the fun starts. So get out your pens and pencils if you own such things. Wednesday. Pre-market, you're going to see PPI month over month for September, which will be the first hint at a wholesale version of inflation numbers. That's coming out pre-market, and it looks like you know, for August they came out negative 0.1%. Consensus for September is 0.2%, and the forecast, based on however many metrics this site uses, is 0%. So forecast right now is disappointment. For bears, I guess, because you are looking for that to come down. So in the afternoon, the afternoon of the session, the evening, we will see the release of FOMC minutes from the September meeting. There can be volatility. There can be some moves hidden within the FOMC minutes release. It's been inconsistent, so I'm just gonna say that they're coming out. 2 p.m. New York time. Could be volatility towards the end of day. And then Thursday, everybody already knows about. Ooh, that's my dog barking in the background. Thursday, you already know about Thursday. It's Cpi Day, volatility. We don't know which way it's going to go. The CPI will release early morning with the markets. Consensus seems to be 6.5%, so a little bit of a hike up on the core inflation rate, which is still not ideal. Core is, of course, cutting out the high moving charts like energy and stuff like that. So they think core inflation could go up 0.2%. Forecast isn't quite so bad, only 0.1%. And the overall inflation, previous was 8.3. Consensus is expecting more downward movement. Forecast is slightly less, but still downward movement on regular inflation. So we'll see what those numbers end up being. It's going to be volatile, most likely. You're going to see market makers hiding all kinds of crazy patterns and actions within that release. So Thursday, with the morning market, CPI. You're probably wondering why China is the other country showing up on this calendar. We'll talk about that in just a moment. Friday is going to be retail sales and consumer sentiment. These have been declining in volatility as far as I've seen. These events, market makers are hiding fewer moves in these releases, but it's something to keep track of. There can be movement, and since it is going to be Friday, good to keep track of, as they'll close a weekly candle. Okay, now why is China on the chart? Well, that's because maybe an even bigger event than CPI released this week. I don't know about that, but certainly could be the same level. Is the Chinese National People's Congress, which is when the Communist Party gets together and talks about all their excitement for the upcoming year. It's kind of like Comic-Con for communism and policy. Yay! I think does it go on for a week? Yeah, it looks like it goes on for pretty much a week. But the main thing I want to talk about is this sort of Saturday into Sunday. I'm not as knowledgeable on this as many other people, so please feel free to check out other sources. But the consensus seems to be that the party will talk about COVID policy going forward, and there are expectations that they could either ramp up zero COVID, which is going to put incredible strain on supply lines, and there can be certainly negativity attached to that. However, there's also an equal amount of folks who think that they could get rid of zero COVID policy or dial it down in this Congress, in this press release, which of course would free up some supply lines, free up manufacturing, and that I think would have positive results on the market. Who knows how market makers actually take the news, but you should have this on your calendar. I believe the policy release is expected for like Monday in China, so I think it's going to be Sunday in the Western world still, either morning or late night, depending on where you are. If this is something that interests you and you want to keep an eye on, have CNBC or Yahoo or Reuters, have that open somewhere around the 16th. I believe that is where it's expected to show up. I think that's enough news for now, or calendar stuff. I mean, so let's head back to the charts and finish up over here. So I think we talked enough about SPY. I guess I'll close it up by just saying my expectations. There was this down gap, so this will be magnetic, this area. Bulls will need to fill it. They have 2 more days. Move this down here. This is day 1. Ooh, that's ugly. Day 1. And we'll see what day 2 brings. So we're looking for this gap, 369 to 373 and change. Should be magnetic, and bulls need to fill this. The 3-day gap theory, I wouldn't keep harping on it if it didn't keep working. I know that every indicator, every pattern has to break at some point. It will break at some point. However, 3-day gaps have worked every fucking time in 2022. And so managing my risk around it has been just fantastic. So we have to mark it until it fails. We're going to keep looking at it because it's just been 100% accurate, which is absurd. It will eventually break. It has not yet. So again, tomorrow will be day 2 of trying to attack the gap. 51% attack the gap. Okay, let's keep going. VIX volatility. Where are we at? I saw, there was a big gap up in the pre-market action. And of course, a gap up means that a gap can be filled. So let's draw. Where's my rectangles? If I'm drawing gaps on SPY, it's only fair to draw the same gaps on VIX. It more or less follows the same rules because when the VIX goes down, SPY goes up. So if this down gap gets filled, it's very, very likely that the SPY has filled its up gap. And this is what we're looking at currently. So it's a pretty decent gap up in VIX. We did not see, there's another type of pattern that we've found working pretty well in the VIX, which is that a 10% move in the VIX, either positive or negative, 10% move is often followed by an opposite move within 48 hours, or 2 trading days. This one here more or less played out. It was about 16% from tip to tail. So you can see this giant red candle. We got 2 relief days. Then it actually did it again. Relief days for the VIX, meaning the market did poorly. Here again was pretty close to 10%. This one actually didn't play out. It gapped down instead. So maybe it's not the end all be all. But it's been pretty good. I do like to see to use the 10%. Here's a 14% candle followed by a red day. So that one counted. Anyway, VIX does have a gap here. So there's going to be pressure on bears, I guess, to hold it up, if you want to say that. And more importantly, I want to talk about what are some of the magnetic numbers or the things that we're looking at to potentially break. One of them is 35, VIX 35. Pull back out. We're still on the daily here, but we're pulling back out, and you can just see how key this point. 35 just refuses to break. They technically closed above it twice. In March on these scary run-up days. I believe that was when the yield was first taking off. So it did close above 35 twice this year. But other than that, it's been a hard resistance. So it is my belief that breaching 35 again will probably send us into our final capitulation of 2022. That's kind of what I'm expecting. So do watch for 35. Momentum is turning up on VIX, suggesting that it has plenty of room to run. However, it's operating pretty high on the RSI. Currently lower highs, and this it could turn back down. It can gap down. We could have already seen the lows for the year if SPY again clears its up gap, and the VIX heads down through this down gap. But momentum's turning back up, and so we will need to watch these numbers, 35 in particular. And then I've talked about this multiple times, so I won't stay on it too long. But if we pull out to the weekly, what is the big number? It's probably going to mark the recession low. Is way up here. Yep, you've heard me talk about it before. Big gap, VIX 44 to roughly 46, 47, and that is formed from the COVID era. The recovery out of COVID left a giant weekly gap on the VIX from March into the first week of April. So yeah, after the volatility and fear spiked up, it ran right back down. Most people here probably remember that, and it left a big, juicy weekly gap, big weekly orders. Yeah, it's gonna be magnetic. It's gonna be a huge gap to fill. And by the way, it doesn't have to stop here if this comes to pass. Bears are gonna want to try and fill this, or VIX bulls, if you want to call them that. This is going to be a big area to watch, and it's my belief that this will mark probably the 2023 recession low. Is once we get above that and close a weekly candle above it, it's probably all she wrote for the bears. It could go, but I don't think it'll go quite as high as COVID. It doesn't seem right. The 75 area, but make no mistake, if it shoots this gap, it will very likely go higher. There's a couple of pivots at like 58. and 66. If we go back historically, where has it been? Housing crisis also went to 80, so it'll be something to watch for. I don't think this. This is me speculating. There's no numbers involved on this next statement. It doesn't feel like this next recession will be quite as bad, quite as jarring, because credit markets are more, Credit Suisse aside, credit markets are more or less prepared for it. We're not going to have this mortgage plunge because big banks don't do mortgages anymore. They got bored of it. So it doesn't feel like this next recession will be quite to this level, but do keep in mind that fear can spike fast if it shoots this gap. And then to the downside, like where should we feel safe again? Again, another number we've talked about, VIX 20. 20 seems to be, going back through all the years, 20 has been a pretty good indicator of fear reducing and calm and feel good feelings. So we'll see if they can crush VIX down to 20, maybe on this rise out of mid-October or at some point later. Skip over FTSE. FTSE looks bad. FTSE's nice and weak. That's the London Stock Exchange. Skip that. Here's futures. We'll skip that. Nasdaq more or less looking same as SPY, I believe, in terms of candles. So I guess the one thing to note is that Nasdaq did just set a yearly low. That's not great, obviously. I think I've talked about in prior streams how important 11,000 was, because that's where I think that should be the COVID. That's the bull market breakout area. So right here in October or November 2020, which you recall we looked at in terms of the gap on the S&P. I was right around here, end of October, beginning of November. This is where the bull run started. Nasdaq similarly has important numbers here. Started there right around, over here. And again, end of October into November. Kind of seeing that 11,000 pivot point, and we're below the pivot. So if market symmetry holds, it would suggest that the Nasdaq has already seen its lows, probably maybe even this week. It would lend credence to my theory that we're about to head up at least one more time before a recession takes us to even lower values, like probably somewhere like Nasdaq 9,000 or maybe even lower to like 8,500. That's in a year from now. But 11,000 is key, so I wouldn't be surprised to see them try and recover it by the end of this week and keep that as the low. Tech QQQ, more or less the same thing, because it's the proxy for the Nasdaq, so not too much to discuss there. It did set a lower low, I'm guessing. Yep, lowest low of the year on tech. Same deal. The number here to watch for, it's probably right around here. I think is it 272? Something like that? No, it's 268. Okay, so yeah, roughly 268 translates to 11,000. So that's the line to be watching. I would not be shocked to see the Qs recover back above, like, again, 268 or so, if they wanted to print that as the low for 2022 and spook the bears. So we'll watch that. 268. Does that correspond to anything? Looks like it corresponds to maybe this low from Friday. I'll put a line there. Why not? Hold my feet to the fire. See if I'm right. See if they get back above 268 to close the week. Moving on, let's take a look at Iwm Small Caps. Not a great day, but overall small caps look healthier than any other index. Overall, putting in like a series of higher lows actually on the daily, and higher highs again on the daily. There you see like higher highs, higher lows so far. Higher highs on the RSI, and if we pull out to the weekly, it's bouncing between these two. What are these rectangles? Oh, these are from the gaps. Sorry, I was wondering why I had those rectangles there. So yeah, you can see IWM also failed. 3 days at the gap. It went down with all the other indices on Friday, but it did hold at this gap that it created in early October. So that's nice to see, namely because small caps can be one of those canaries. They can recover first. It's kind of a juggling competition where you you can say, oh, is it tech that's going to lead us out of this dip and be the canary, be the first one to recover? Clearly, tech is at the moment not really doing it. It might if it closes the week green or bounces. But right now, small caps look decently. They're doing decent. We do have to clock that. This is a very clear bear flag. This is a. Where's my brush? So yeah, this that is too ugly. I can't leave those. Here we go. This here, that is bear flag, bearish convergence. Bearish confluence. But if it just zooms out of here, then you've got a bottom on the small caps. So it's something to watch. I'm just saying they look better than the other indices, and they can be market leaders. So something to watch for. Let's keep going down. How'd Apple do today after the gap down? Decision, just a pure doji. Opened at 140.42 and closed at 140.42. I didn't even notice that. Wow, it closed on the dot. TA deniers in shambles. Just a pure doji, as pure as it gets. Spinning top doji. They have no idea what they want to do. Technically, it traded inside of the prior candle, which suggests I wouldn't call this a harami, but technically it's an ugly harami. It suggests that it could go green tomorrow because it traded inside. Yeah, just something interesting to watch for. But that's about as pure doji as you get. That could go either way. In general, Apple is, of course, trending down still. Momentum has flipped down. You'd want to see them testing. It looks like they got close to testing these closes at 138. So being a market leader, it's important to see. I'm more used to Apple going up into earnings and then selling off after. So, their earnings are going to be, it looks like, on Thursday, the 27th. So maybe they turn around here and get, something like that. I'm really off today on those. So maybe see something like that into earnings, with a couple of dips along the way. But right now it's higher lows. It could bounce here. We'll just watch that. Microsoft has been demonstrably weaker than Apple in the semiconductor space. They've got a lower low, so there's nothing to really save it. I don't know how Microsoft interacts with earnings. It looks like it kind of goes either way, although they're usually green. There's green into earnings, green into earnings. This was green into earnings. But, during this bear market, it was red into earnings. Kind of a mixture into earnings. So I don't really have a take on Microsoft. Just to say, they look weaker than Apple does. I'll go into the Dow in a second. I just want to take a look at good old meme boy Tesla. Kind of a spinning top. There's nothing really interesting here. Tesla looks like garbage. Not quite a falling knife anymore. It looks like they might be stabilizing as momentum down here sort of flattens. Still very bearish. Don't get me wrong. I'm not saying this is bullish, but it looks like things are flattening and maybe RSI could turn up on this little spinning top. On the weekly, it sure looks like a falling knife. If you start seeing closes below like the last weekly sting down of, looks like they closed at 223, which they were already below today, and the sting low was 222, so not very far to go. I mean, you're talking very small percentages. If they start breaking down below 222, and of course today's low of 218, then it's right back to falling knife status. This does not look healthy. Momentum on the weekly just crossed fully negative, fully bearish with last week's close. So really bad. Really, really bad. Let's see if it turns around. Nvidia, kind of the same deal. Semis were hinting at maybe turning around last week, and that's just all gone. Look at this big old gap down. Being a gap, it can be magnetic. They can recover. Based on today's action, doesn't look like it, but hey, something to watch. Overall, looks really, really bad. Momentum has completely flipped over. Not pure bearish yet, but it's certainly heading that way, and it's set entirely new lows on the daily and on the weekly. Yeah, really, really bad for Nvidia. Okay, enough about the individual stocks. Let's go take a look at DIA, or the proxy for the Dow. If you adhere to Dow theory, then kind of similar to the small caps, it looks better than other indices. Right now, it's working on a higher low. Can't argue too much with that. We'll see, if it holds. Momentum has kind of rolled over, but it's not too bad yet. And on the weekly, that's a bear flag for sure. If you're looking at candle closes, gotta call that out. It's a bear flag. It can go down. However, similar to S&P, it ended last week in this sort of, inverted hammer, shooting star pattern, but being at the bottom of a downtrend, it's not as bad, and honestly gives you some really good stop loss points. Very, very clearly defined stop loss points. It's always nice to have those. And so far, it's actually closed above last week's open. So if it turns around into the end of the week and if this weekly candle, turns green, maybe the Dow leads us out of this dip and into the back half of October, where I still think could see some green across indices. They've got the same gap down to deal with as the other indices, but much like IWM, it looks better than S&P and Nasdaq. Not great, but better. So something to watch there. Lastly, let's do our bond canaries, starting from my least favorite. Oh man, I yield the multi-assets are just all over the place. It's just gaps on gaps. Overall, downtrend, technically higher lows. I don't have anything to ascribe to this. It is what it is. I don't like high yield as much. Let's go into the ones that are more important. So typically, HYG, the high yield bonds they were kind of the canary for me all year. I have found that LQD, which I'll talk about next, has been more accurate lately, so I'm saving that for last. HYG did agree with today's downward movement. In fact, really agreed with it. It went down a full over 1%, whereas the other indices were down about somewhere between 0.75 and 1%. So, yeah, definitely agreed with today's movement. However, bit of a divergence as you've got. Oh, nope, sorry. I thought SPY closed lower, or I mistakenly thought that SPY had closed lower today. Never mind. It's not a divergence. But it is still higher lows. I know it doesn't look great. I know it's red. I know it's in a downtrend. I'm not telling you this is bullish. However, there is the potential to print some higher lows here if it turns around. And you can see it's just dealing with, I'm not going to draw any lines here because there's no single line that I can really discern. But you can see how this is going to be a big pivot area, high volume area, roughly from like 71.3 to 71.7. They have closed below 71.3 for the day, but if they re-enter this area and start turning it into support, maybe that's the bounce we're looking for. Maybe that translates into upward movement across markets. LQD, which has been hilariously accurate, calling tops, near-term tops and bottoms in the markets. It predicted, last week turning over, October Tuesday, it put on a red candle where I believe SPY was green, if I'm not mistaken. Yeah. Look at this. Look at that divergence. Oh, man. SPY had its big gap up green day, and LQD, I don't like to use the word predicted, but it sure feels like it. It sure feels like LQD put a shit ton of pressure on this, on SPY to turn around, if not just straight up predicting it. So, yeah, red, big gap down, red, and then SPY followed. So with LQD being more accurate more recently in terms of the investment grade market sort of adding pressure to other indices, it's same as HYG. It has this lower low. I'm not going to say this is bullish as momentum has turned over on the daily. It's obviously red in a downtrend, but for now, it has held. It didn't even get below this kind of sting low from whatever that was on 2 Thursdays ago. So it closed above that sting low, which is nice to see. And of course, it closed above the end of September low. So right now it's printing lower lows. Oh, sorry, higher lows. It's printing currently a higher low, which is nice. It's not bullish, but it is the first opportunity to turn bullish. So we'll watch that. Additionally, it's got it's still pretty high up on RSI. So even if it does close a day below looks like 101.15, 101.12, even if it closes below here, the RSI may give it a bullish divergence later in the week. So we'll watch that as it comes in. Lastly is crypto. Crypto is first in my heart, but today was last in the charts because it's just entirely dependent. There's just no organic volume. I mean, what a down day for volume and for crypto. It's just not of interest right now in terms of retail. So it's following the indices, which is why I went to them. Ignoring Grandpa Bitcoin, which is currently fighting. Well, here, let's look at the weekly. Is there anything interesting? Not really. It's got this bear flag going on, and looks like it tested kind of the bottom of the bear flag here. On the daily, it's just breaking down. Currently, Bitcoin is contending with this sting low from Saturday, 19,237, and it's just kind of looks like it's staying right around that point. It hasn't made a decision yet. If it closes below Saturday's low, if it closes below 237, or maybe you want a little more buffer room. Let's say it closes below 19.2 today in a few hours. That's going to suggest more downward movement because that's a pivot. And then the next targets are going to be, the prior closes at 19,000 and 18,950, which is a line we've had on our chart for a while. It's been a huge pivot. Take this one minute by minute, hour by hour, day by day. On ETH, our beloved ETH, I made a quick comment over the weekend about how Saturdays into Sundays have worked. It's like clockwork. Pretty much, stagnant Saturdays into like red Sundays, stagnant Saturday into red Sunday, stagnant Saturday into red Sunday, and we had a stagnant Saturday into a green Sunday this time. That was nice. The problem being, even though it was green, this is the first time that we've closed underneath this latest channel as resistance. So every other time, this Sunday back in mid-September, came down right to the top of this new channel, which we didn't know was a channel at the time, but it was formed by it. So it came down to the top of the channel, and it did its thing, and then the following week was inside the channel. The following Sunday was closed outside the channel, but quickly we recovered back up into it and went to the midline. We failed back out of it, and now we closed a Sunday as resistance. So even though Sunday was green, it's not a great look, because once you start closing something as resistance, a pattern as resistance, it suggests, another leg down. And right now, there's no reason to think that that's not going to happen unless we see some serious end of day action. Looks like the sting low from yesterday was right where we are, 1307.21. And we're currently battling with it right at 1307. It just went from 0.09 to 0.24 to point. Anyway, I'm not gonna track the minute by minute, but you can see how closing below this sting low. I'll even mark it on the chart so that we have it. You can go down to like the 15-minute candles, and you can see just how much we don't want to close below it. Make this nice and thick, nice thick juicy boy. You can see how it's been a pivot all day long, and closing below it would be bad. Ha ha ha! That sounds really dumb. I sound like a dumb TA person. Wow, closing down is bad, but there's a reason why. It's been a pivot all day. And it was below yesterday, and closing below lows suggests more lows. The next target would probably be, there's going to be a little a little bit of support at 1275, but I think 1235, 1240 would probably be a larger target if this confirms out of the channel. And it sure looks like we're doing it. Weekly on ETH, more or less the same as Grandpa. We're in a bearish continuation pattern. It's it's not quite a bear flag, kind of bear flagged into a wedge into a renewed bear flag. Not super clear, not super crisp, and that's due to a lot of that's due mostly to the low volume, is where patterns don't really form as clearly and concisely because everything's kind of messy and just bot driven. But it's a bearish continuation pattern. We're still, more or less confirming out of that same channel, albeit in an uglier fashion. Uglier meaning like it's not clear and concise. So for ETH, it's kind of just watching the dailies, not terribly interesting. If it closes below, like I said, 1307, maybe manage your risk as we head back down into the 1200s. Okay, that should wrap it up for today. God, how long did I stream today? Oh, just about an hour. It's funny that even with the quote unquote live close stream that I did and all the rambling, I still ended up faster than a lot of my prior streams. So maybe doing this off the cuff is actually better for editing and editing myself. I kind of move through things faster. Are there any questions or things you want to look at on the charts that we can sort of delve into before I close down the stream? Otherwise, I'll wrap this up and put any closing comments probably in the daily discussion thread. Thank you, JackFX, for joining. All right. Yeah, that'll wrap it up. Thank you, everybody, for watching. And if you're catching this after the fact, when it's been uploaded, thank you for watching as well. I've been Kbrot. This has been 51% Attack, and I'll talk with you guys and meme with you guys on the subreddit. Take it easy.